On the morning of Wednesday, March 8, 2023, Silicon Valley Bank was the 16th largest bank in America, with $209 billion in assets and a clean regulatory rating. 44 hours later, it did not exist. No fraud detonated it. No wave of bad loans. It was killed by the safest assets on its balance sheet, government bonds, and by the accounting rule that let it pretend those bonds had not lost a dime. This was not a niche lender. Silicon Valley Bank held the operating cash for roughly half of every venture-backed startup in the United States. When it went down, a major stablecoin lost its dollar peg, startup payrolls froze, and the Federal Reserve invoked a systemic risk exception it reserves for events that could break the entire banking system. To understand how a boring bond portfolio did that, you have to go back 2 years, to the moment SVB had a problem almost no bank ever has: too much money. Between 2019 and 2021, the technology boom flooded SVB with cash. Its deposits roughly tripled. Its assets grew 271% in 3 years, while the banking industry as a whole grew 29%. Startups raised enormous funding rounds and parked the proceeds at SVB, money the bank paid almost nothing to hold, and money that could leave at any moment. A bank has to do something with its deposits. SVB took this flood of short-term, near-zero-cost money and bought long-dated bonds, United States Treasuries and agency mortgage-backed securities, at the lowest yields in a generation. By the end of 2022, it held about $117 billion in securities, with a weighted average duration above 6 years. It had locked in tiny fixed yields for the better part of a decade. This is the original sin, and every trader knows its name: a duration mismatch. Your assets are locked up for 6 years. Your funding can walk out the door in 6 seconds. As long as interest rates hold still, you earn the spread and everything looks fine. The instant rates move against you, the value of those long bonds falls, and unlike a loan, a bond marks to the market whether you like it or not. In 2022, the Federal Reserve raised interest rates from near zero to 4.5%, the fastest hiking cycle in 40 years. Long bond prices fell hard. By year-end, the unrealized loss on SVB's held-to-maturity book alone had grown to more than $15 billion. Here is the killer statistic. That paper loss was larger than the bank's entire tangible equity. On a mark-to-market basis, Silicon Valley Bank was already insolvent. It simply did not have to say so. That last part is the mechanism most coverage misses. Banks sort their bonds into 2 buckets. Available-for-sale bonds are marked to market, but held-to-maturity bonds, about $91 billion of SVB's book, are carried at cost, as if the loss does not exist. The $15 billion hole lived in a footnote and never touched reported capital. 2 rules turned this disguise into a trap. First, as a smaller bank, SVB had opted out of counting unrealized securities losses against its regulatory capital, so it screened as well capitalized while economically underwater. Second, accounting rules say that if you sell even a slice of a held-to-maturity portfolio early, you taint the entire book, forcing every bond to be marked and the full loss crystallized at once. SVB could not quietly sell its underwater bonds to raise cash. Touching them meant detonating the whole hidden loss. So on Wednesday, March 8th, SVB did the only thing it could. It sold $21 billion of the smaller, already marked available-for-sale book, taking a realized after-tax loss of $1.8 billion. Then, to plug the resulting hole in its capital, it announced it would raise about $2.25 billion in fresh equity. Management framed the whole move as proactively strengthening the balance sheet. The market read it correctly. A bank does not dump $21 billion of bonds at a loss and ask investors for equity from a position of strength. On the same day, Moody's downgraded SVB, and the crypto-focused lender Silvergate announced it was winding down, priming the market for banking fear. The prospectus itself disclosed the loss. Every sophisticated depositor could now do the math. And they did the math on their phones. On Thursday, March 9th, depositors tried to withdraw $42 billion in a single day, roughly a quarter of the entire bank, the largest single-day bank run in American history. By the close, SVB had a negative cash balance of about $958 million. It could no longer settle its own outflows. The stock fell about 60%. Why did it move so fast? Because SVB's depositors were the most flight-prone liability that exists. The overwhelming majority of its deposits, by the Federal Reserve's estimate, around 94%, sat above the $250,000 insurance cap, completely uninsured. And they were not strangers to each other. They were a tight network of venture funds and their portfolio startups, coordinating in real time over group chats and social media. When the venture firms told founders to pull their cash, the run executed at the speed of a wire transfer. There was no teller line to slow it down. It was the second day that proved fatal. On Friday, March 10th, another $100 billion in withdrawals was queued to leave, bringing the two-day total to roughly $142 billion, more than 80% of every deposit the bank held. It could not be met. Before that second wave could clear, California regulators closed Silicon Valley Bank and handed it to the FDIC at midday during business hours, which almost never happens. 44 hours after the disclosure, the 16th largest bank in the country was gone. The autopsy found fingerprints. For roughly 8 months of 2022, the exact window in which rate risk was exploding, SVB had no chief risk officer at all. Its chief executive, Greg Becker, sold about $3.6 million of stock on February 27th, less than 2 weeks before the collapse, under a trading plan filed weeks earlier. And on March 10th, hours before the FDIC walked in the door, the bank paid out its annual employee bonuses. The damage did not stay contained. Circle, the issuer of the USDC stablecoin, had $3.3 billion stranded at SVB. Over the weekend, USDC broke its $1 peg and fell toward 87 cents, a boring regional bank nearly triggering a crypto collapse. And the panic was already jumping to other regional lenders that shared the same profile: long bonds and a mountain of uninsured deposits. So the government broke the glass. On Sunday, March 12th, the Treasury, the Federal Reserve, and the FDIC invoked a systemic risk exception and guaranteed every deposit at Silicon Valley Bank, insured and uninsured alike, overriding the $250,000 cap entirely. Equity and bondholders were wiped out. The depositors were made whole. And the Federal Reserve launched a new lending facility, the Bank Term Funding Program. Its decisive feature tells you the regulators understood exactly what had happened. It lent banks cash against their bonds valued at par, at full face value, not at the depressed market price. In a single stroke, the Fed neutralized SVB's precise failure vector, handing every other bank the liquidity to avoid selling its own underwater bonds into a run. The carcass was carved up quickly. On March 27th, First Citizens Bank bought roughly $72 billion of SVB's loans at a $16.5 billion discount and assumed about $119 billion in deposits. Its own stock jumped sharply that day. The cost of making depositors whole fell on the Deposit Insurance Fund, an estimated $20 billion, roughly $18 billion of it to cover the uninsured money that, by law, should have taken losses. The reckoning came in reports and lawsuits. The Federal Reserve's own postmortem blamed management's failure to manage rate risk, supervisors who moved too slowly, and a 2018 rollback that had eased scrutiny on banks of exactly SVB's size. The surviving banks were handed a $16.3 billion special assessment to refill the insurance fund. And in January 2025, the FDIC sued 17 former executives and directors for gross negligence. Here is the trader's verdict. Silicon Valley Bank did not die of a single bad bet. Every leg of it was, on its own, survivable: the duration bet, the accounting choice, the deposit concentration. Stacked together, they became a machine for converting a slow, quiet loss into a sudden, public one. The bonds were the fuel. The accounting was the trap that meant the loss could only be revealed all at once. And the depositors were the spark that revelation was guaranteed to light. SVB spent 2 years building a bank that could only fail one way: instantly. This has been Capital Autopsy.